Okay, we are live right now. Welcome everyone to our meeting today. I'm Özyürek. I'm an economics student, undergrad economics student, and I'm interested in corporate finance, macroeconomic analysis, and money and banking. Today, I'm going to be moderating this meeting. It is with great pleasure and an honor that I introduce to you our two guests, Mr. David Andolfatto and Mr. George Selgin. Mr. George Selgin is a senior fellow and director at the Center for Monetary and Financial Alternatives at the Cato Institute. He is also the professor emeritus of economics at the University of Georgia. He is one of the founders of the Modern Free Banking School, and he's written numerous articles on topics concerning monetary economics. Mr. David Andolfatto currently serves as a vice president in the Federal Reserve Bank of St. Louis. He is an economics professor at the University of Simon Fraser, and he's written numerous articles about labor markets, government debt securities, the implementation of monetary policy, and all other topics about financial plumbing. So today, our discussion will be about stablecoins and CBDCs, or in other words, central bank digital currencies. And before we start, I'd like to start the discussion with CBDCs. But before I start asking you questions, I'd like to give you, the audience, a brief overview on CBDCs. So, central bank digital currencies are a digital form of central bank money issued by the central bank to households and businesses. CBDCs will allow households and businesses to have accounts at the central bank. So, traditionally, the commercial banking system, the Treasury, and several other governmental and financial institutions have had accounts at the central bank. So it is a really interesting concept, especially with the beginning of the pandemic. The research on this topic has gained more and more pace. Some people believe that the implementation of CBDCs may disintermediate the banking system. Some people believe that implementing CBDCs will help enhance the payment infrastructure. So there is a lot of dimension to this topic and a lot of thoughts. So my first question to you is, what are the most pressing issues do you think CBDCs will help solve? And in what aspects do you think central bank digital currencies will contribute to our lives the most? Let's start with Mr. David Andolfatto and continue with Mr. Selgin.
Thank you very much, Kaya, for organizing this. It's a pleasure to be here and to have a discussion on this issue with George. So to answer your question, I guess in terms of the potential impact of CBDCs on our lives, much I guess depends on exactly what form one thinks the CBDC is going to take. I have to admit that I was initially very warm to the idea, but that my enthusiasm for the project has kind of waned a little bit as of late. In part, I think actually George has been responsible for this, but also others. What do we mean by a CBDC? I mean, for me, a CBDC is just they just constitute liabilities that are issued by the government in digital form that can be used in everyday payments and to pay for debts, for example. We already have stuff like this in paper form, of course, but so CBDC is kind of a digital representation of that. And by the way, it need not be issued by the central bank. It could be issued, say, by the Treasury, for example. Now, if we already have digital currency, as you pointed out, and it's supplied and managed mainly by what I would call a private sector, public sector partnership between the government, central bank, and commercial banks. So people already have access to digital payments. in this form. So it seems to me that, when I ask myself, what would be, imagine that now, actually, kind of the thought experiment I asked myself was, imagine over the past 50 years, people had access, could open up checking accounts with their central bank. What, if anything, would be different, assuming that the central bank adopted all the latest technology and followed the same sort of protocols that commercial banks do today, charge the same sort of fees and interest rates? And the answer is kind of like, we probably wouldn't have been able to tell the difference because, whether you have an account with a central bank or a commercial bank, from the user's point of view, would have been largely indistinguishable. And so the impact that a CBDC is likely to have on society will, to a large extent, be determined by whether or not one expects the protocols that are followed, the pricing schedules that a CBDC would offer, would differ substantially from what already exists out there. And I don't know, maybe a lot of people complain about kind of excessive markups, interchange fees, and this. There's a sense in which strong, powerful players are making monopoly profits, and a CBDC would play a countervailing role there. But on the other hand, one could imagine that if that was indeed the issue at stake, that a more direct kind of regulatory approach, just mandate, floors on deposit rates, for example, and caps on fees would be an alternative approach. So reflecting on the question in that way kind of leads me to conclude that I don't think that one should expect the introduction of a CBDC, this digital security provided directly by the government to make payments, it would have very much of an impact on society.
Okay, thank you. Mr. Selgin?
Yes, thanks a lot. I really appreciate also the opportunity to talk about digital currency and stable coins, and especially to do so with David and for your audience. It's a lot of fun. So I'm a little different than David, and yet not so different. David just explained that he went from being warm on central bank digital currencies to being what perhaps might be lukewarm. I've gone from lukewarm to cold around the same time. I used to say, and by used to, I mean, as recently as a year ago, I would say, well, I'm kind of torn on this subject. And the reason I was torn was because, on the one hand, I don't favor getting the central banks, giving the Federal Reserve, for example, or other central banks too much power, that considering what they already have to do. And I also worry about the possibility that a central bank digital currency could be a prelude to the removal of physical currency, as some people, but not all, as some proponents of digital central bank currency, but not all, have proposed. But my view has changed, and anyway, but I also recognize that currency is the horse and buggy of a modern payment system. Paper currency is very, very old and technology, and something that really we should be able to replace with something better. So if we're relying on central banks as our source of P2P or peer-to-peer payments media, maybe we should not only let them, but expect them to improve the technology. I've changed my mind mainly because I now believe that there's no improvement that central banks could achieve that the private suppliers of payment services can't achieve and achieve more efficiently if we let them. And here I want to say something to David make a point that will appeal to David as a bicycle rider. I used to be a bike rider and racer myself. And we used to say, never stand up if you can sit, and never sit if you can lie down. And the analog here is the idea that central bank should never monopolize a payment service if it can compete with the private sector. And it shouldn't compete with the private sector if the private sector can provide the service efficiently and well. And in this case, in the case of digital currency, I think the private sector is much more capable of handling all the tasks that proponents of central bank digital currency expect it to handle, and doing it better if central banks clear the way for the private sector to do so, as some central banks have done a lot better than others, like the Bank of England, for example, has really opened its doors to fintechs, which are the main alternatives here apart from ordinary banks. In particular, I don't think that banking the unbanked, which is one of the goals that many people think will be best accomplished or can only be accomplished with central bank digital currency, requires it at all. What really is important there is that we enable either ordinary banks or fintechs to provide substitutes for plain old bank deposits, commercial bank deposits. In the case of ordinary banks in the United States, a fairly recent initiative by the FDIC called the Bank On Initiative has made great strides. It's basically an effort, a program to make to make bank accounts more available to people who usually can't afford them or don't find them convenient. And it's doing a heck of a job, and I think we'll soon see it make even further gains. But the other option is to allow a greater role for non-bank fintech payment service providers, which already have provided all kinds of alternative payment services, from PayPal and various kinds of Apple payments and Square and so on. We've seen tremendous achievements by them and new options introduced by them. And here I'd like to say that what I have in mind is actually kind of a compromise between what CBDC proponents are proposing and the status quo. Because what I think is necessary for central banks to encourage these private alternatives, these new private digital currencies, if you will, is that they open their books to more widely. That is, that they make accounts available more widely, not to just ordinary people, not to Tom, Dick, and Harry, but to the fintech firms that can in turn provide efficient digital currencies. And the Fed right now hasn't made many such accounts available, even to fintech firms that have managed to secure banking charters. And fortunately, the Fed is considering making rules that would make it easier for such firms to access the Fed's final settlement facilities, which is where the Fed really does have a monopoly that can't conceivably be done away with unless we had a whole new monetary standard. So I'll just make a couple more quick points. As far as the possible advantages of central banks, it seems to me there are three areas worth considering here. One is capability. I don't think central banks have any technical capacity that the private sector doesn't have. Indeed, it should be pretty clear that they're Johnny-come-latelys here. The only reason they're thinking about digital currencies is because the private sector got them doing so through its own prior innovations. Competition, I would like to say there's not much that can be gained here either, because the marketplace in question is already extremely competitive. And it should be understood that central bank competition is a very dangerous kind of competition. I won't go into it at length, but suffice to say that it's pretty obvious that when central banks lose, they don't lose. They're still there. They enter the payment industry. They may drive out private rivals, but they seldom fail in their own efforts. That is, they'll keep on doing whatever they started doing, whether they're making money or not. So that's a problem from the point of view of efficient competition. And finally, just a quick word about regulation. I'm not saying that the private sector should be allowed to do what central banks are proposing to do without any kind of central bank regulation. Of course, there may be, and probably is, a good case for imposing regulations on private sector digital currency suppliers of all kinds, not just ordinary banks, depending on the risks that they take. So my plea isn't for unregulated private provision of digital currencies in place of central bank provision, but it is for having regulated private digital currencies do what people are proposing central bank digital currencies should do. That's all.
Okay, thank you. So from my perspective, I mean, there have been rounds of stimulus checks in the United States, and such payments were in very large amounts. And these payments have increased the leverage ratios of the banks. So perhaps in the future, it may become increasingly difficult for banks to absorb large periodical payments from the Treasury. Let's suppose that such a difficulty occurs. I think central bank digital currencies can help ordinary people to circumvent such difficulties and transact with each other more seamlessly. This is my perspective. Having said that, I'd like to move on to our second question, which is, in what ways will CBDCs shape monetary policy? And more specifically, in terms of policy implementation, how will open market operations be affected as people move funds into and out of their CBDC accounts held at the central bank? Let's start with Mr. Selgin, continue with Mr. Andolfatto.
Well, there was once a time when introducing when I would have said that central bank digital currencies can have a major effect on open market operations, if in fact the demand for them is highly volatile. It can have an effect on the conduct of open market operations, in that just as when there's a big surge in demand for currency, or when there used to be, there was need for offsetting open market operations to keep bank reserves from being depleted, and therefore to keep bank deposits from contracting more than currency went up, so that the money supply as a whole would stay still. In the new system with abundant reserves, this usually isn't a problem. That is, we don't rely on open market operations anymore in the United States, and many other central banks don't rely on them for fine-tuning their money stocks, because the supply of ample reserves means that small changes in the reserve stock don't have the money supply implications that they used to have. The banks just, they have more reserves than they need, so it doesn't make them contract credit. That's basically the story. Now, the exception to this is, of course, if you have a mass movement, a really big movement out of bank deposits and into either central bank currency or its digital equivalent. And that's where that is, of course, the issue of disintermediation that was mentioned before. Now, David and I have exchanged ideas on this before. My view is that there is a disintermediation risk here, greater than there had been in the past, because most of the time anyway, people are very reluctant to hoard large amounts of currency. So runs into currency have been very uncommon. If you distrust your bank, while you go to another bank if you can, and that would usually be the end of that. There would not necessarily be any general disintermediation crisis. And again, this is because currency is not a safe or convenient medium to hold, so long as there are any bank deposits to trust. Now, central bank digital currency or central bank retail accounts, that's a different story, because they offer the same convenience and safety as ordinary bank deposits without any risk. So here it's more easy to conceive of a situation where a general distrust of banks, even if it's not even if it's mostly about certain banks and other banks don't seem as bad, could lead to a general disintermediation crisis with people taking their money out of ordinary banks to put in their central bank accounts. And that's all the more true if the Fed follows the advice of many proponents of central bank digital currency by paying a rate of interest on those accounts equal to the rate of interest it pays presently on bank reserves, which is a higher rate, by the way, than most bank deposits yield, for the simple reason that banks have to cover intermediation costs, and the Fed wouldn't be doing that if it followed the advice I mentioned. So central bank digital currency could prove to be a very competitive rival to ordinary bank deposits, and at certain times especially might give the banking system as a whole a hard time. Now, David has suggested that the Fed could always adjust the interest rate it pays on these accounts, assuming it can set a different rate from what's paid on bank reserves, as a way to discourage any disintermediation crisis. And I agree that that's technologically possible or technically possible. However, I worry that in practice it might not be, depending on how the law is written. If, for example, the law itself incorporates this idea of paying interest on reserves, the matter will be out of the Fed's hands and will be a matter of political decision-making. Something like that happened, by the way, in the past when we had postal savings accounts in the United States, and the rate of interest paid on them was set by statute. And sure enough, that interest rate became higher than rates on ordinary bank deposits during the Great Depression. And if it hadn't been for limits on how much money people could put in their postal savings accounts, that could have made the banking crisis of the time even worse than it actually was. So I would worry about that. I'm not saying that it's not possible to design a law that guards against this contingency, but I would certainly be worried about any law that fails to do that.
Okay, thank you. Mr. Andolfatto?
Yeah, I guess on that question, my own view is to the extent say central banks are targeting interest rates, I mean, the open market or operations are kind of going to occur in a manner that's consistent with interest rate policy. And I think this is going to be true whether or not a CBDC is in place. As for the concerns that George and others have expressed about the potential for disintermediation, or kind of whether or not a CBDC, an interest-bearing CBDC, may promote sort of these flight to safety episodes, as George mentioned, I'm a little bit skeptical about that. I mean, in principle, I can see how it happens, of course, but the question, of course, at the end of the day is always going to be whether or not the CBDC is designed appropriately. First of all, in terms of actually just disintermediating banks, there's a constituency out there that suggests that this is actually something that's desirable. Who's maybe not necessarily disintermediating, but also compelling banks to substitute away from demand liabilities into kind of more secure forms of financing. I mean, why should banks be financing so much of their portfolio using demand deposit liabilities, for example? I mean, I think that's a bit of an empirical and policy question. So there's that. If banks sense that this is a problem, they could always substitute into more stable forms of higher cost, mind you, but more stable forms of funding. The answer to the question also kind of depends on kind of the conduct of the central bank. I mean, what to the extent of the central bank would be willing in such circumstances to extend, through the discount window, loans to support banks in the event of these supposed episodes. And as George mentioned, hopefully the central bank would be given the discretion to kind of to alter the CBDC rate in a manner that it finds desirable to potentially prevent or mitigate these types of large flows. But you know, in to push, George offers an example of postal savings, but I mean, here, let me give you another example. A lot of people expressed the concerns George had when the Fed established its overnight reverse repo facility. They were worried about whether this might provide a flight to safety phenomenon, a valve for that sort of phenomenon. That never occurred. And in any case, you know, in the United States at least, and I don't know about other jurisdictions, but you know, all U.S. persons are already permitted to hold interest-bearing accounts with the U.S. Treasury. Just go to www.treasurydirect.gov. You can open up an account, an interest-bearing account of U.S. Treasuries, and you know, there's a flight to safety vehicle if I ever saw one. If George is concerned about a CBDC promoting bank instability, perhaps we should shut down this service that the Treasury provides as well. So those are my comments on that. But Kaya, before you go on, yeah, I can't resist but going back to just reply briefly to kind of some of the comments George made earlier in the previous question. And I think this speaks to the issue of when one is bringing up the issue of central bank digital currency, what do we mean exactly by it? If you recall, I defined it as securities issued by the government in digital form that can be used to make payments. I did not specify in that definition who was going to be running the payment service, the payment rails. And I left that purposely undefined there. And we should maybe make a distinction between retail level CBDC and wholesale. And I share with George kind of my skepticism that a central bank itself might be outside its wheelhouse in dealing with at the retail level. But on the other hand, if I heard George correctly, I think one could say that he supports a wholesale version of CBDC. Essentially, you know, that's just fancy language for saying we should be more open to granting narrow banking charters to qualified intermediaries, perhaps like Square or PayPal or whatever, DM, for example. And so, but that's an old idea. This doesn't depend on CBDC. I mean, this is a narrow banking proposal. It should enhance competition. I'm all in favor of that. People have been in favor of that in the past. So this is could be, you know, a wholesale version of CBDC. George is in favor of, contrary to his stance that he's against. He's really against the central bank administering, micromanaging a retail level CBDC. Finally, kind of this idea that, you know, we have central banks here and the private sector here, and they're all competing against each other and working at cross purposes. I should point to you the case of Canada. Canada operates very differently, perhaps, in other jurisdictions. I don't know. In Canada, by an act of Parliament, we established a Canadian Payments Association in 1980 that oversaw the transition from paper-based payment systems to electronic. The Payments Association, commonly known today as Payments Canada, is a nonprofit, and it's basically an association of private banks, non-banks, cooperatives, government representatives. I mean, the central bank is represented there as well, and everybody talks to each other. I mean, it's not perfect, but you know, it's not like we need to promote a system where different constituencies are operating at cross purposes. And I think Canada provides a very good example of how a payment system can evolve and adapt to a very changing, rapidly changing technological landscape. And you know, I kind of judge the Canadian example as kind of a success and a model to strive for. So let me end there. Thank you.
Yeah. So actually, at the beginning of the COVID-19 pandemic, there wasn't a lot of like the safety situation. I mean, we saw T-bill yields plunge to zero with the anticipation that the Fed would also lower short-term key interest rates down to zero. And we also saw an increase in the use of the overnight RRP facility. But I don't think the disintermediation fears were real at that time, because the amount wasn't as high as it is today in terms of RRP use. And I would also like to give an example from Turkey. The Turkish banking system is in a liquidity deficit, meaning that the central bank has to supply a minimum amount of money, Turkish lira, to the banking system. And also the stock of the funding depends on the value of the collateral that banks hold. So I think if such a central bank digital currency were to be implemented here, people would have to go to their, give a prior notice to their banks about when they're going to be moving funds out of the bank. So those banks can also report the related amounts to the central bank, and then the central bank can increase the amount of repo and swap funding it provides to banks, depending on the stock of foreign currency and Turkish government debt security collateral. So I would like to move on to our discussion on stablecoins. And before I ask questions, I would like to give the audience a brief overview. Stablecoins are cryptocurrencies whose value is pegged to a fiat currency or to an asset. The most popular form of stablecoins is a fiat collateralized stablecoin. And usually these stablecoin issuers, they maintain a one-to-one peg. To give an example of this, let's say a stablecoin issuer issues $1 worth of a single stablecoin. So when there's, let's say $10,000, let's say there is $10,000 worth of stablecoins, each having a value of $1. In order to maintain this peg credibly, the stablecoin issuer has to have reserves that it holds. So these reserves can be in the form of bank deposits, they can be in the form of treasury bills, they can be in the form of commercial paper as well. But of course, the issuer of commercial paper is important because if the issuer of the commercial paper were to go bankrupt, then the stablecoin issuer which owned that commercial paper may have a difficulty. It may, they call breaking the buck. It may be unable to preserve the peg. So my first question on stablecoins is, what makes stablecoins stable in value? We know that trust plays a very important role. We also know that the arbitrage principle can also hold from time to time, but what really makes the value of stablecoins relatively stable over time?
Who would you like to start, Kaya?
Where we would like to start first. Okay, we can continue with Mr. Andolfatto.
Okay. Very good. Yeah, well, what makes them stable? You hit the nail on the trust, I guess. The depositor perception of the willingness and ability of the issuer to honor the par redemption promise, assuming, in fact, that it's a par redemption promise. I mean, there's many types of, paradoxically, at least in theory, and I think a bit in practice, I mean, these structures, banking structures, stablecoin structures, can be designed in a way they can put in, for example, redemption gates, what they call redemption gates, redemption fees, or they could threaten to suspend redemptions in the event of, say, a run on the currency, and that these threats could actually theoretically credibly be used to support the stability of the peg. This is kind of running on kind of a Diamond Dybvig sort of idea. So I guess that's basically a concise answer to your question. Kind of a depositor perception of the willingness and ability of the issuer to defend the peg is what would guarantee the stability of a stablecoin.
I'm going to offer a somewhat different perspective. I've been delving into these stablecoins for a while, and the more I did, the less I thought they fit the conventional story where that applies to banks, and somewhat less to money market funds, where it's a question of redeemability and trust and the backing, et cetera, et cetera. In fact, I've come to the conclusion that it's quite a different story for most of them. For many, the algorithmic stable coins, the arbitrage doesn't really play much of a role. It's all a question of the underlying program. And some of those programs do a terrible job actually maintaining the peg, it should be said. All the failures of stablecoin pegs so far, all the so-called runs haven't been runs. They've been failures of these algorithmic stablecoins where nobody could run on them because there's no promise of redemption, no redemption mechanism. Then there's Tether. And Tether, let's face it, until Diem comes online, Tether is the elephant in the room. Tether is the only one big enough for anybody to worry about. So they're either worried about Tether or they're worried about what Diem is going to look like. And Tether, too, is an odd beast. David mentioned redemption gates. Indeed, if you look closely at Tether's redemption provisions, they are paper thin. It is actually very difficult to redeem Tethers. It's costly. You have to have at least $100,000 worth to redeem. And then they reserve the right not to under vaguely specified circumstances. As far as I can tell, redemption is not really an important mechanism here. And indeed, I don't think it's resorted to very much. People sell Tethers, but they don't redeem them for the most part. Which brings me to a second point, that to a very important extent that's often overlooked, I think the stability of stablecoins, or more accurately, the demand for them, which of course has to be stable if their value is going to be stable, rests on the fact that you can do stuff with them that you can't do with anything else. They are specialized exchange media, particularly for cryptocurrency transacting. And by gosh, you're not going to give up on them and go into dollars if what you're looking for is something you can buy, exchange for cryptocurrencies conveniently. So that is a persistent source of demand for these things that allows something like Tether to survive, let's face it, despite every kind of infirmity. And I've mentioned this online at Twitter, only semi-facetiously. I said, if I wanted to run an experiment to cause a stablecoin to fail, I would make sure its assets were, that no one was quite sure what its assets were, but there was good reason to suspect there was a lot of dubious stuff on its balance sheet. Then I'd subject it to all kinds of shocks, macroeconomics and otherwise, scandals, lawsuits, COVID. And then I'd sit back and watch the thing collapse. Except we've run that experiment and it won't collapse. Something in our theories is kind of lacking here, I would say. And so I think we need to think harder, as I've tried to do, not completely successfully, about just what it is that's supporting these systems. Oh, I forgot to mention, too, in the case of Tether, that, of course, it's extremely important that there are huge players behind it who are willing to invest in a lot of resources to maintain that peg. That's very important. It's analogous to the money market funds that have big sponsors behind them that are willing to invest in them to keep them from breaking the buck. And the bigger the deeper their pockets, the more they can avoid breaking the buck despite big shocks. And so that's another part of the story. Huge vested interests have every reason to not want to see Tether break the buck and to put money into keeping it from doing so. They play, as it were, a role opposite the role of a George Soros when we think about the breakdown of the British pound peg some years ago now. So all of these things have to be taken into account. My own conclusion is that for reasons that are at first that remain somewhat difficult to grasp, stablecoins are, after all, less vulnerable to the kinds of runs that we would expect them to be vulnerable to if they were truly analogous to banks and money market funds. And I think I'll just leave it at that rather than imply that I know more than what I just said.
I also believe that in some ways, the credibility of a stablecoin peg is quite similar to how a central bank would try to peg an exchange rate. Like if a central bank were to peg its currency to a foreign country's currency, it would need to have a sufficient level of FX reserves to be able to instill confidence in the market. So I think there is a similarity in these two occasions. And that brings me to the...
sorry, Kyle, I would just add, though, that the difference is it's not clear who the George Soroses are who can afford to or have an interest in trying to attack the stablecoin pegs. And that's an interesting question. There are a lot of people in those markets who have strong incentives to want to see those pegs stay in place, and that's important.
Yeah, and this brings me to the second question, actually. As you know, stablecoins play a very crucial role in the smooth functioning of the crypto market overall. When people move their funds into Bitcoin, and then from Bitcoin they can switch back to holding stablecoins due to a more efficient level of transaction. They can do so by transacting stablecoins for Bitcoins or for any other crypto asset. It can become a lot more efficient process for investors. So indeed, the stability of stablecoins peg is really important. My question is, what kind of role do stablecoins play in financial stability and in the crypto world? Let's continue with Mr. Selgin.
Well, obviously, the pegs are extremely important for people in the crypto world. As you said, the fact is that that stable coins, as long as they behave like dollars, are uniquely capable of allowing people to engage in transactions much as they would if they were using dollars themselves, but to do so in markets where dollars are really not real dollars are not really an option. And part of the problem here is that conventional payment systems are not well able to allow people to deal in cryptocurrencies. And there are all sorts of reasons, regulatory and otherwise. Some are indeed trying to establish cryptocurrency banks with master accounts at the Fed. And for such cryptocurrency banks, they would be able to provide honest to gosh US dollar payment services to for crypto coin traders. And that could change the demand, it should reduce the demand in theory for stable coins. But until that happens, the stable coins are going to remain important, and their value is going to depend on their stability. So, the real question is what happens when things go south in these stable coin markets, and what serious effects they can have, not only in the cryptocurrency world, or not especially in that world, but in the rest of, among other persons who are not participating directly in cryptocurrency exchanges. And the big fear is that a major stablecoin sell-off or run would result in the mass liquidation of underlying assets other than cash, including treasury securities, but commercial paper and CDs and such, and that this would depress the prices of those assets and harm other institutions that have invested in them, as well as harming the issuers of those assets, who will find the market for them has shrunk. This is the big concern. I think so far it's overrated, partly for the reasons I explained earlier, mainly the very sticky demand for stable coins and the fact that many aren't runnable at all. But that could change, and DM or one of its underlying Libra components could change it.
Yeah. Let's see. I guess, Kaya, you asked about, I actually forgot the question. Maybe you could repeat it for me.
Yeah, sure. What is the role of
Change the
stablecoins?
subject.
So the question was, what's the role of stablecoins in financial stability and in the crypto world?
Yeah. So these stable coins, they're I see them as kind of just normal innovation in finance, in the world of finance. They're very popular in the crypto world. To a large, their popularity comes from two sources, I say. One is to the extent, there's the regulatory arbitrage dimension to it. The extent to which, for example, they don't have to abide by standard KYC, know your customer requirements. I mean, are they more efficient? Yeah, they're more efficient because standard banks and even institutions like Coinbase that have hosted wallets have to abide by certain set of regulatory restrictions that are going to, of course, make it more costly to process these payments. And to the extent that these stable coins don't abide by those regulations, or that they're not there, of course they're going to be more efficient, but they're just more efficient in circumventing existing legislation. And then, of course, the question is whether you think that that's a socially desirable activity or not. That's kind of a separate question. So they have a comparative advantage there, at least for the right now. Well, let's see how the regulation evolves. Or they might actually be also offering bona fide improvements in the way in which information and accounting is performed. I mean, the blockchain, for example, the different types of protocols out there that may indeed provide an engine for more efficient payments. Now, to the extent that's true, I mean, there's nothing that would prevent incumbents to kind of just wholesale steal that technology and adopt it themselves. So I think at the end of the day, what these stable coins are going to do is promote competition out there, whether people want to or not. I mean, the incumbents are already innovating like mad, I have to say. It's not like MasterCard are standing still. It's not like these institutions are standing still. They understand this threat and they're innovating like crazy. And part of this, I guess, is perhaps motivated by the emergent threat that these stablecoins provide. So that's probably a good thing, I would say. In terms of financial stability, I mean, I don't know. I kind of I'm a little bit torn on this. I mean, part of me says, well, whatever. Let caveat emptor rule in this market. Because as long as they're transparent and they're relatively small players, relatively speaking, and as long as investors and depositors are well informed, why shouldn't these structures be permitted to exist, or at least under some form? I'm a little bit less sanguine than George, perhaps, because if you look at Tether, for example, Tether has a huge holdings of commercial paper, for example. And even though it's still relatively small, it's huge, but it's still relatively small. You got to imagine a world where it gets even much, much bigger, right? So and of course, when we say that these institutions are fragile or unstable, we don't mean that they're going to fall apart tomorrow. I mean, these events can happen once every 10 years, once every 20 years. The thing is that are they susceptible to these types of events, and what are the systemic kind of consequences? Now, if they're relatively small players, you just say, well, whatever, just let them fail like regular firms fail, and caveat emptor, and that's the case. But policymakers kind of have to think about different types of worlds that might emerge. One, for example, where these institutions have large holdings or dominant players, say in commercial paper. And so that if they fail, I mean, who cares about the depositors, right? But depending on the protocols that they have in place to kind of meet redemption requests or whatever, you have the classic kind of phenomenon like fire sales, for example, in commercial paper, that in principle could permeate through the whole financial markets and impose kind of these bad financial conditions on the rest of the economy. This is kind of what we mean by systemic risk. I'm not sure how important, relevant that risk is, but it's certainly something that as a policymaker you have to think about. You just have to think about that. So, and we're still thinking about that. So.
By the way, speaking of competition, to what extent do you think stable coins can rival private payment alternatives? Mr. Andolfatto, we can continue with you.
Well, like I say, to the extent that they provide bona fide improvements in the way they manage accounts and process payments, I would expect that they could coexist. Why not? I mean, I don't think they're going to entirely displace the incumbents, because the incumbents can innovate against it. And so what I would predict is what I think I see in history is this kind of coexistence. These different institutions may serve different constituents, right, who have particular needs, and so I kind of imagine a world of coexistence. Yeah, they can compete, and they should be permitted to compete, I think.
Mr. Selgin?
Yeah, I agree with David on that. Of course, they are, as I said, they're niche media of exchange. They serve particular markets, very specialized markets. Nobody uses them for anything else. Most of the players who use them are pretty big players, I'd say. Fairly sophisticated. So they're big boys and girls. They don't really need that much protection. It's not like the small bank depositor who needs the FDIC. I would say that that they play an important role, but I would also say that that part of that role is a result of regulations, and that other kinds of private providers might be serving that market and serving it very efficiently if they were allowed to. And so to really allow true competition between stablecoin providers and other private market suppliers of exchange media, it's important to give the latter, it's important to create opportunities for the latter to tap into the Federal Reserve and other central banks' payments rails and see what they can do, and make for different legal arrangements that allow non-stable coins to be more useful in buying and selling cryptocurrencies. Now, David's right. We're not going to see KYC or anti-money laundering laws. They're not going anywhere, and they're not going away, I mean. So there's only so far that you can go with letting, let's say, more traditional payment media suppliers compete in these markets, but they could compete a lot more if the government would encourage them to, or make it easy for them to do so.
Thank you. I think we have still a couple more minutes, so we can I can select a question from the comment section. So this person asks, "Great discussion. I'd like to ask a question. How would the commercial banks lend money to customers when there is CBDC and no bank deposits?"
Can I start that one and let David respond, because I was going to bring this point up. Something that often, in my opinion, gets set aside in these discussions, though the questioner has quite appropriately brought it up, is the role of bank loans, bank lending in society. And though there's no time to go into the argument here, there are good reasons why banks use demand deposits to fund bank loans. There's actually a great deal of synergy between those things, even though many people view the combination as dangerous. It actually has its advantages, not the least of which is the fact that ordinary bank deposits are actually a very stable funding source, quite unlike say, the wholesale deposits that a lot of financial institutions were relying on during the big financial crisis, the 2008 crisis. So, and there is a clear question of what happens if indeed we have something like central bank digital currency that does permanently do away with bank lending based on ordinary deposits, as some people would like to see happen. I think it would be very costly. Now, the only proviso I would add is that innovations are also happening, fintech innovations that are creating more and more substitutes for banks as sources of credit. To that extent, the loss of ordinary bank loans as a result of there being fewer demand deposits won't be as costly. But I still believe that it would be costly and will remain so for a long time. Anyway, that's my thinking about this topic.
Thank you.
Yeah, I guess I think I'd largely agree with the view that George just expressed, except that perhaps I'd say that what those costs would be as a quantitative matter is kind of up for debate, especially in light of the prospect of these innovations that would permit these capital markets to work more seamlessly without banks. Banks, we usually see banks kind of in lesser developed economies, right? I mean, they're kind of like banks and financial markets are to some extent substitutes. And yes, I do agree that, that the banks do have an advantage in that they can fund themselves with deposit liabilities that offer you and me the flexibility that we love. I mean, we love the fact that if we want, we could go to the ATM and withdraw cash on demand at par. I mean, that's something we all value, at least for the time being. And banks can exploit that by offering lower deposit rates. But if they didn't have access to deposit funding, they would go for other sources of funding. And as George mentioned, a number of people have been promoting that idea for a very long time. I mean, the Chicago school, just a narrow banking system. This is the whole question of whether the old question of whether money and credit markets should be separated. George is of the view that no, not necessarily. There's synergies there. I think that's kind of right. The question is, how important are these synergies? Are they big? Are they going away? I don't know. I think that's an empirical question, something we should keep an eye on. What would be the costs of eliminating deposit funding or demand deposit funding for banks? What would be the cost on the economy? I guess the answer to that question might depend on economy by economy. The extent to which the financial markets are more or less developed. In the United States, I don't know. I mean, I kind of think we'd still get on with our lives. But it's an empirical question at the end of the day, I would say.
Okay, thank you. So we've been recording for around 58 minutes. So I think this marks the end of our live session. Again, I would like to thank Mr. Andolfatto and Mr. Selgin for being with us here today. It was a privilege. It's been a privilege to have them here with us. And thanks so much to everyone who've joined the live meeting. And take care.
Thanks, Kaya.
Thanks a lot, Kaya.
Thank you.
Yeah. Hello.
Yes.
Yes.
Hey, Tansu.
It was a great talk. Thank you all.
Yeah, it was fun.
Hopefully you enjoyed this session.
This was live, by the way, Mr. Kendilli.
Oh, sorry. No, we end the broadcast.
Oh, okay.